Good afternoon, guys. Welcome to another webinar by Streak. This is our eighth webinar. In this webinar, we are going to cover mean reversion strategies. We are going to talk about what is mean reversion, what is the theory behind mean reversion, okay, which technical indicators can be used to create mean reversion strategies and how to go about doing that, what's the thinking behind them. And the last topic is going to be optimization of mean reversion and picking the right scripts. So let's begin. So, what is mean reversion? Mean reversion is a theory used in finance that suggests that the asset prices return back to the long-running mean um, after a significant short-term move. What basically that means is if the price in short term has gone up, at some point of time, it will come back to its long-running mean, right? This is the long-running mean. I have plotted 100. I think 1 second. I plotted 100 moving average. So that's our long running mean. The prices tend to come back. If the price has gone down significantly in short term, it will come back to the mean. So that's the theory. It basically means that whatever the move might be after some point of time, whatever the short term move might have been, after some point of time, it will come back to the short term mean. Okay. Now, issue with mean reversion is it's really hard to identify, and most of the things can be a self-fulfilling prophecy. What I mean by that is if the stocks in short term, let me zoom in here. If the stocks in short term have gone up significantly, and I see 2 or 3 red candles form, then I might draw a line and think that okay, a reversion might be taking place like this, right? Or a reversion might be taking place here, but both of the times it didn't take place and it took place here. So what I mean by this point, second point, is without proper testing of the strategy, without proper analysis, mean reversion strategies can act as if you just think that a mean reversion is happening based on visually what is being seen without having it properly tested, it can be a falsely sort of thought idea, which is basically something just to justify your bias or your interests or whatever it might be. But unless until it is probably back tested, anything where you say that a mean reversion might be happening might be superficial. It might be something that you're just creating out of thin air, right? The other point is mean reversion strategies are one of the most common class of strategies next to momentum trading strategies. We'll cover momentum in a later webinar, but yeah, it's one of the most common, and there is a lot of material out there which covers different mean reversions strategies, indicators which can be used for, but all of them have been tested for those kind of scenarios where the explanation has been given. So without you backtesting for the stocks you are interested in or you want to trade with, it doesn't make much sense to use them, right? Now coming to the indicators, which is the important part of this entire webinar, is which kind of indicators, which kind of technicals, price actions can be used to identify a mean reversion. Now RSI is an indicator which shows whether the stock is overbought or oversold and in which reason it is in, right? So if a stock is overbought and suddenly the stock prices start to fall, a mean reversion might be taking place, and that's what it is being implied here. That's a very common strategy. Let me just quickly, I'm not going to show that as a backtest, but let me just quickly show that as a theory in chart, right? So here it basically says that if the stock is overbought and the price will fall, and the next day sort of it fell, but you actually don't know, because here it was showing that it is in overbought region, but next day the price opened even higher. Same goes here, right? So without proper backtesting, you actually do not know. Even though it is in overbought region, the price might keep going up, and you don't know what point to rightly enter at. In this webinar, in the coming strategies, we'll explain how to use for especially for mean reversion, a combination of RSI or RSI category of indicators like CCI and all, you with some other kind of indicators to properly identify mean reversion. Other kind of indicators are those indicators which basically calculate in some form or other the distance from uh, the price movement, or basically are able to identify extreme and unusual price movements. Extreme and unusual here means price movements which are not the general kind of uh, price movements associated with the moving average price, but they are significantly upward movements or downward movements. So those indicators are standard deviation, Bollinger Bands, money flow, etc. And we'll cover using one of them, we'll cover the strategies going ahead. Other indicator is MACD. Now, MACD is a very good indicator. I'll just explain how. So let me just plot Reliance. Let me plot a day candle, hour candle. So you see MACD is being calculated here based on 12 and 26 moving average, correct? Now, what is 12 and 26 doing? Let me just plot it and I'll explain. So I plotted a 12 moving average and I'll just change this one to be 26 moving average, obviously with a different color. Okay, MACD is nothing but the difference between the fast moving average and the slow moving average. The wider the distance, the wider the price has moved up, the faster the price has moved up in the short term period. That's what MACD signifies, right? If I zoom here, the value is 12, and if you see the value in the difference between this price and this price, it is around 12. Okay, 1372 minus 1386 is around 12, right? That's your MACD value. So MACD is the difference between fast moving average and slow moving average. Now, why is this important? If the stock price has kept moving up fast and then the gap between the fast moving average and slow moving average starts to reduce, that might signify a mean reversion. We will cover this as a strategy also going ahead, but keep this in mind. Okay, that MACD is the difference between fast and slow moving average, and MACD signal, which is this red line, is the moving average of MACD itself of period 9. Okay, now the last one is Ishimoku. Ishimoku indicator was requested by a lot of people and has been added. There will be a dedicated webinar on Ishimoku very soon. But in this case, we will basically use Ishimoku to create a simple mean reversion strategy. Okay, coming to the first strategy, as I explained, MACD is difference between fast and slow moving average. As the gap between slow and fast moving average increases, MACD becomes higher than a level, higher than a value, right? And post that, if MACD starts to fall below MACD signal, that means the gap between the MACD here, MACD, the gap between the fast moving average and the slow moving average starts to reduce, that point becomes a good shorting opportunity, provided that the MACD was higher than a specific certain level, which is different for different stock. Now, MACD level of 10 is shown here in this screenshot of the strategy, is because the stocks that for where it will work are in range of thousands, where the fast moving average and slow moving average has gap of 10 rupees. If you want to use same or similar, build similar strategies on stocks which are in price range of 300 to 400 rupees, then you have to plot the chart and see what is the difference or what is the average MACD value. So it will be somewhere around 1 to 2. Okay, so let's go and build the strategy. I'm going to use Streak. It can let you create strategies with ease. So we are looking at Reliance Capital, a 1 hour chart, quantity is 10. We'll run the back, we'll sell because the strategy is to sell when the stock has moved up significantly. Now, I will, as I was explaining, we want to say MACD is higher than a number. Now, a number is a level. That means it basically, this number lets you tune how far the fast moving average, or how far quickly the price has gone up before it starts to fall. Okay, so here I'm saying 10. That means the fast moving average and the slow moving average has a difference of 10, and MACD has crossed below MACD signal. Why this? It basically shows that MACD is no longer going up. It has taken a turn and it is starting to come back down. Okay, it is starting to come back down somewhere here, somewhere here. Okay, now we'll keep stop loss and take profit very simple. Win to loss ratio of 1:2. 1% stop loss, take 2% take profit, and we'll give it a name. So I'll just say webinar 8 S1 strategy 1. I'll just run the back test. So while the backtest is running, let's keep in mind what we have done. We basically want to identify when the price has quickly risen far up. To justify or to measure that, we are using fast moving average as the point, and the difference between fast moving average and slow moving average is nothing but MACD indicator. Right now, the backtest has finished. This is an hour candle backtest, so it has run for last 1 year. And in last 1 year, Reliance has given us around 40% returns. Now, with even though the stock has moved up and given 40% returns, doing a short strategy, that means selling it, has still given us 6% returns, with a where it took 11 trades, out of which 10 were profitable and only one was loss. And your average max gain is 262 rupees. That means in a single trade you made this much, whereas the max loss in any trade was 50 rupees. The average is again coming back to the average win to loss ratio, which we have given as 2:1. The very key and the most important point the most important thing to observe here is that the max drawdown is 0.062, which basically means that the volatility or the risk of this strategy on this back test was only 0.62%. The lower the MACD value, if you have seen our old webinars, we cover there. The lower the MACD value, the closer it is to zero. Okay, it can be minus 0.1 or 0.01. The better the return, the better the strategy is. That means it's less volatile, and for a max drawdown of 0.62, a return of 6%, even when the market has gone up, is a significantly good result. If we see the trade log, only one trade has been lost. That was because it got squared off. Rest all the trades have exited in profit. Okay, so if you guys have any question regarding this, you can write in the chat box and we'll be happy to answer that. Let's move on to the next example. Next sample. This is a Bollinger Band strategy. As I was explaining earlier, how RSI can be used to identify reversion. RSI and CCI are almost in similar category of indicators. We are going to use upper Bollinger Band and CCI to identify a mean reversion point, a mean reversion opportunity. What the strategy says is, it's very simple. If a red candle is formed above, if a red candle has opened above upper Bollinger Band, and CCI shows that the stock is already overbought, then a reversion might be happening. Okay, let me just plot that here. Let me just plot Oro Pharma. This strategy is on 5 minutes, so it is very much suited for an intraday, from point of an intraday strategy. Let me just remove these indicators. I'm just plotting Bollinger Band and CCI. So while I'm doing this, all these values have been identified based on backtest. So without backtesting, you actually do not know what levels work. So, so what levels work for a given strategy, what levels would work and do good for a specific script. So backtesting becomes a crucial point in being able to make anything that will work in any market. So we are looking at Oro Pharma. Let's add Sun Pharma as well. Pharmaceutical stocks, obviously something outside pharma. Let's add Hexaware. Let's see how that does. This is on 5-minute chart. Um, it's a sell quantity. Just give 10. Now, as I explained, the strategy is the candle should open above the upper Bollinger Band. That means open higher than UBB. Period is 29. How these periods have been identified? They have been identified by backtesting and optimization. Then we want to say that the candle is a red candle, so we basically can say open higher than close or close lower than open. Both are same. And the most important part of this strategy is making sure that CCI is higher than number 122, basically to show that the CCI is also showing overbought. What it means is this is overbought region, right? So if a candle, let me just plot it, show it here. I'm just searching for a point where the candle has opened above, a red candle has opened above CCI. So something here. So here the candle opened above. It's a red candle. It opened above above the upper Bollinger Band, and CCI was above 122. It was about 131. The strategy would have strategy would have given a short signal, and then you could have taken profit here. I mean, again, this is just one thing that we see in chart, but I cannot obviously manually check every single occurrence of this event. That's why we use backtesting. Now here exit is close, crosses below, middle. So this is because to make sure we are not being over greedy, or the long-term trend, short-term trend might come back. We basically exit as soon as the close price crosses the middle Bollinger Band. That means if I short here, I'll exit here. This is the middle Bollinger Band. Okay. We'll also keep the same win to loss ratio as 1 to 2%. So to make sure that our risk to reward ratio is 2:1, I'll just give it a name, webinar 8 S2, and I'll run backtest. Let me just make sure I have made the strategy sell. Okay, it's correct. Okay, great. So it has given 8% returns on Sun Pharma. Sun Pharma went up 6%, but this sell strategy generated 8% returns, more than how much it went up by selling. Max drawdown is 1.7%. Your max gain and max loss are around 1:1. That is because we are exiting much sooner, based on the exit condition as well. Oro Pharma did much better than Sun Pharma. The period return was 2%, but the strategy made 10% shorting it. Okay, and this strategy is for last 3 months because it is running on 5-minute candle. In last 3 months, it generated 32 signals. That means if you divide it uniformly in 90 days, 30 signals, approximately one signal every 3 days. Hexaware also did somewhat fine, but it didn't give as great of return as the pharma stocks. Okay. Again, you can verify each and individual trade by going through the trade log. Max drawdown, it's very important to make sure max drawdown is as low as possible. It's 2% here. That's okay because the return is 10%. And winning streak is 15. That means 15 continuous trades are profitable. And losing streak is 2. That means when you lost, you only lost 2 times consequently. Number of wins and number of losses, the ratio is also very good. Right, so this was our second strategy. This is the power of combining properly 2 different category of indicators to identify mean reversion. Okay, Coming to third, it's Ishimoku Cloud. Many people have been asking for this indicator, and we have added it, and it's finally here. We will be covering a dedicated Ishimoku Cloud webinar very soon. We'll let you know on that. But here we'll use a simple Ishimoku Cloud strategy to perform a short. The strategy is very simple. When the close price crosses below baseline and the baseline is flat, it might signify a reversion. Very important to keep in mind here, it is a 15-minute candle interval on a Henkin-Nashi chart, okay, not on the normal chart. So let me just plot that. Let me just zoom out. So let me just make it 15-minute chart and Henkin-Nashi. So I'll remove all these indicators and I'll just add Ishimoku Cloud. Great. So let me just find out where the strategy would have taken a shot and just show that here for us to understand it clearly. Also, the leading span also has the same color as baseline. So I'm just changing that color. Give me a second. Okay, great. So this strategy basically says if the close price crosses below the baseline, this red line is the baseline, it will take a short, provided that the baseline is flat. A flat baseline means the current value is same as the previous value. Okay, using offset, we can create that. Let me go and create that strategy here. Let me add SBI and any other stock, let's say Ashok Leyland, Canara Bank. And the time period is 15 minutes. It's a sell strategy. Quantity is 10. To close, process below Ishimoku baseline. So here you can select individual signals, and this gives you a lot of freedom in the kind of strategies that you can create. To say that a baseline is flat, I'll just say baseline is equal to Ishimoku. I'm saying current baseline is equal to the previous baseline. To access previous baseline, I say -1. To access previous to previous baseline, I would have said -2. Right? This exit is quite simple: 0.5% stop loss and 1% take profit. Let me just give it a name. Webinar 8 S3 strategy 3. Very important. The chart is Henkin-Nashi chart. So I'll just click here and make it Henkin-Nashi. Now it's a sell strategy. Let's quickly go and run that. While it is running, let me just show you the chart. So it basically is taking a short here. It will take again take a short when it finds a flat Henkin-Nashi crossing below the close price. So the backtests have run. We see that for SBI, even though the stock has given 7%, it gave 4% returns, shorting it with a max drawdown of 1.67%. The win to loss ratios are preserved here because this doesn't have an exit condition as such, right? So this is how you can use Henkin-Nashi to build a mean reversion strategy. Obviously, this is a very simple one and doesn't have an exit criteria. In Ishimoku Cloud webinar, we'll cover more in depth of using Ishimoku versus various chart types to build many more strategies. Okay, coming to the next point, optimization in mean reversion. It's very important to make sure the mean reversion strategies are properly backtested, because mean reversion strategies are really hard to make as they are trying to bet against the market's prevailing trend. If the market is going up, seeing a few or a single red candle and saying that the market is going to go ahead down is a bit difficult and riskier thing to do. But with proper backtesting, as we have shown in the webinar with sample strategies, it is possible to be done. Okay, and mean reversion strategies are very famous and very very well used, because here you have the first movers advantage, in the sense if you see a red or two red candles and you take a short, even though the market was a long, you are aware that if the strategy is doing, if it is a good and probably backtest strategy, you are ahead and you can catch the top and the bottom, not the bottom but at least the top, very quickly in a very proper way. But that's because of higher rewards, this strategy is much difficult to build and it is much riskier if not tested properly. Now, other point to keep in mind is what kind of indicators to use. As we have given you some example of indicators, obviously there are many more. It's very important to keep in mind what kind of combination of indicators you are using. We use Bollinger Band with CCI. It could have been also RSI, doesn't matter there that much. But the category, it's the combination of a momentum versus oscillator, trend following versus momentum, trend following versus oscillator indicator. That is what is important. And you can find all those combinations by backtesting it. And if you have any questions on that, you can write to us and we'll help you out in that aspect as well. Coming to the last point is choosing the right kind of script. As mean reversion basically says that the after a short term move, the price will come back to its mean. That means the stocks you should choose to run mean reversion strategies on should have moved either up or down. So any form of trending, either trending up or trending down, scripts are ideal, as they have the opportunity, or they have the space to move back to the mean. Whereas stocks which have been sideways, moving very close to the mean, long running mean, doesn't have that much space or opportunity which can be capitalized upon, right? So the ideal stocks are basically stocks which have been trending up or trending down. They are ideal candidates for mean reversion strategies. Any question, guys? Kindly write it in the chat. We'll be happy to answer that. If we are not able to answer there, we just reached out to us on support@street.tech, and we'll be happy to answer you there. Do feel free to follow us on Street Tech, our Twitter channel, to not miss out on any updates that we put out there. Okay, great, guys. And as always, have a nice day. Thank you. Bye bye. Take care.